who's going to moderate our next panel, or our first panel. Jim is the head of equities and fixed income in DNB markets in New York, so responsible for that activity throughout our business in North America. He's been with DNB since 2012. He's been the cornerstone of building our equity and fixed income sales and trading business in the United States, and a key member of our team. He's a great moderator, a great questioner. I'm completely biased, and I welcome him up here along with our panel participants. Thank you.
So, yep.
Good morning.
Good morning.
I hope this is on. Yeah. Ladies and gentlemen, lawyers and bankers, it's a pleasure to see you this morning, and it's a pleasure to be about to introduce the owners panel. Before I do, I want to give a thank you to Marine Money. So after a decade of working with you, I finally graduated from the grumpy owners panel to the happy owners panel. In November of last year, if you invested $1 million with these companies being your portfolio, that portfolio would be worth about $3.5 million today. Some returns are more spectacular than others, but everyone on this panel has had a impressive year of earnings and share price gains, and it's great to see shipping back again. To my left, John Wobensmith, CEO of Genco. John Coustas, the chairman and CEO of Danaos. Graham Talbot, who is the CFO of Atlas Corp, which is the parent of C-SPAN. Øystein Kalleklev, who is the CEO of Flex LNG, and John Hadjipateras, who is the chairman and CEO of Dorian. So we've got 5 different segments represented up here, and I'd like to start with Graham first. So two questions. First of all, thank you for being up here on the ship owners panel. You are a major ship owner, but you're not a shipping company. So I looked on Bloomberg yesterday, and Bloomberg gives you who your peers are and who your customers are. And they've got your peer group as being shipping companies, and then I look at all the analysts who follow you, and they're all shipping analysts. So first question is, what's the challenge that you face in terms of getting your company valued appropriately and valued against the right peer group, number one? And number two, could you just spend a minute just talking about your 70 new build orders and the contract coverage that you require around those?
Sure. Good morning, everyone, and thanks a lot, Jim. I do feel like the odd one out here, and I'm trying to work out whether I'm the ugly duckling or the swan. I'll just have to leave that until the end of the session, I think. So, in terms of valuation in the business, Jim, you hit the nail on the head. So I'm glad someone in the room understands that we're not necessarily a shipping company. That's one of the biggest challenges I think that I have in terms of my investor relations focus. We're very much positioned with all of the shipping industry, although we don't have the same risk profile. We don't have any exposure to freight rates, to customers at the end users. Our customers are the big container ship companies, and our contracts are sort of watertight, long-term charter contracts. Yet, whenever anyone sneezes or anything happens with freight rates, our share price moves. So that's part of my challenge as CFO, to help the market understand how we correctly position. To your other question, Jim, so we started the year with around 127 vessels, and we brought in another 4 second-hand vessels, and at the moment we're executing our new build program, which is a total of 70, and that's 7.6 billion investment, and that's brings our total contracted cash flow up to just over $18 billion. So in terms of scale, that takes us to about 2 million, just under 2 million TEU. And once again, back to the earlier question, that differentiates us quite a bit from some of the other people that we're sort of put against. We focus very much on long-term contracted cash flows with our customers. We do have some short-term exposure to that's a minor part of our portfolio, and it's really not where we focus our business. So that's sort of the key part of where we're at. I think the other piece is this year's been a very big year for us on the financing side. We did a 200 million NOK bond, which is sustainability linked at the beginning of the year. Then we did another 300 in the NOK bond market. Then we did a 500 million private placement, which was sustainability linked. And then we did our 750 million US high yield, which was the first of our blue transition bonds. So we've been busy.
Yes, you have, thank you. And I'm sure most of the panel is appreciative of your new build program. Maybe not all the panel, but most of the panel. John Wobensmith, talk about what makes a leading shipping company and how you sustain it.
Well, first of all, Jim and I have a little gift for you, Graham. And we have a thank you card, and I will read it to you. Dear Graham, we want to thank you for your 70 new build orders in 2021. We appreciate your efforts to keep the best shipyards in the world as busy as possible. And that is on behalf of the entire dry bulk shipping industry. I have no doubt you all will make a good return on those ships, but thank you, because we're making a good return now as well for filling those slots up. So much appreciated. So I do look at you as a swan, by the way. Look, we have tried to create Genco in terms of a best-in-class shipping company. I think there are several things that really make that up, and I would tell you that it's not something you do overnight. It's been a very long journey for Genco in particular, really going back since 2016. But I think there are a few important things. I think being a pure play and concentrating on one sector is a very important aspect for investors. I believe that a very well-defined and strong capital allocation strategy is important. We have done we've initiated a new value strategy at Genco. We have paid off 45% of our debt by the end of this year. If you look at where we were in January 1 of this year. And the idea behind that is to pay a good size sustainable dividend. And I emphasize sustainable because unfortunately in dry bulk and in other shipping industries, we haven't had consistent dividends. Dividends have been turned on when times are good, but then when times are bad, because companies can get over levered, we've had to turn them off. And Genco was one that had to do that as well over the years. So we think a strong capital allocation strategy, low debt, low break-even rate, ours is about $8,000 a day, being able to convince shareholders that over the long term, you never have to turn that dividend off during any quarter. It may fluctuate, but you don't have to turn it off. Is one of the key things. We also spent a lot of time bringing our commercial management in-house, bringing our technical management in-house, and having more and more control of our own destiny. Particularly in the iron ore sector, there is a lot of focus and raising the bar on performance, safety, and particularly out of Australia, and being able to control that internally rather than having to be at the behest of other managers is also a very, very important thing for us. So it's been a long journey for us, and I think we're well on our way to being on the right track.
Thank you. And I gotta be careful with the Johns because there's three of you up here. But John Hadjipateras, I'm gonna ask you the same question about, having developed a leading company, and Dorian's had a long string of years of outperformance in terms of day rates. As you look forward and you think about the human resource side of the business, you think about the importance of diversity going forward. Give us your reflections on how you sustain. Give us your reflections on how you sustain a leading company.
That's a nice question. It's a better question than you put to me on the phone yesterday when you asked me, what does it take to be best in class? And I thought, are we going to the Westminster Dog Show? Or so we have focused from the beginning on delivering directly to our clients, basically. So we've always done our commercial, our strategic, and our technical management in-house. And we feel that creates a loyalty, a reciprocal loyalty, both with our workforce and with our customers and with our service providers, be they bankers or insurance or others. So we kind of we think we differentiate ourselves with that because not many others do. But we persevere, and in time we've seen, we built a substantial fleet in a very short period of time, and we've seen it sort of now come into its sweet period of earning potential, basically, where our market is, we're lucky because we're involved in a market where we carry a product which is both cleaner and healthier for a lot of its users than the alternative. Thinking of domestic use of LPG. It's been expanding in the double digits and more recently in the high single digits, and we forecast it will continue to expand in the mid to high single digits. But of course, we weren't, the 70 ships that you ordered wasn't soon enough to stop the order book growing in our sector.
Sorry.
So we have we have an order book which is a little over 20%. That's never comfortable. But we've gone through recently 2 periods of building, one of market fluctuations in 07 and 16, and each of those periods. In one of those, the order book was 40%, and the next was similar. So we think that with the change in the trade pattern, the increase of exports from the U.S., the increased use of the Panama Canal, which creates delays and inefficiencies, the requirements, the EXI requirements, which will result in some of the ships slowing down and increase reduce the supply and improve the balance. We feel that the market is going to absorb this round of ordering, and that's where we're at.
Thank you. Øystein, first of all, congratulations on your results yesterday. And your stock is a triple from where it was a year ago. We can't talk about strategy until we get your outlook first on the market.
Thank you. Yeah, I think it's gone. We listed here 2.5 years ago in US, so we felt the share price was too low to issue any stock, so we listed it at 11, so it's 23 now. So it's gone pretty well. Outlook for market is pretty strong. The Baltic LNG indexes are $300,000 plus, and these are the tri-fuel ships. So if you have the new kind of ship, mega XDF ships, the premium there is $60,000. So we are sniffing at $400,000 per day, which are, you know, great rates. But keep in mind, that's very few fixtures, because that's
You're supposed to smile when you say that.
yeah, so, you know, the rates are very high because there's no ships left. So Clarkson's report on Friday had one ship available in the water out of 600 plus ships, and they have one ship coming open in 2 weeks, and then one ship coming open in 1 month's time, and that's our ship, Flex Volunteer. So that's how limited supply is. Luckily, however, we have 3 ships on index. So of course that's why we delivered good results on Tuesday, but you know, we really hiked our revenue guidance from $85 to $100 million to $110 million. And you know, at that kind of level, you know, we should be making quite a lot of money. So we also lifted our dividend capacity. So now we put it up to 75 cents per share, which is $40 million every quarter of dividends, which gives about 14% yield. So yeah, so things looks good.
And how do you see beyond the winter season? Do you have any view on how the market plays
If you
out?
look at the FFA, you know, this is the freight contract for next year. It's like 100,000 for a Typhoon ship. 1 year time charter rate is 125 for new ships. So of course it looks good, but there are too many people ordering ships. So I wish Graham could order 80 ships.
It's great to have so much support.
Of course, you know, we are very focused on capital discipline. If you're going to make money in shipping, you have to invest right. So of course we invested our ships when prices were $180, $185 million. They are $210 million today. So we took those ships, we got those ships, the 3 ships last delivered this year. So, but now it seems like people are rushing to the yards because they are afraid that they're going to be empty out of the slots. And so 24 is mostly booked now. 25 is where the slots are. The Qatar is going to take more or less all the 26 slots. So of course there are not much slots left. But I think, you know, people need to keep a bit calm about ordering all these ships. That's I think where the biggest issue of the industry is. I'm also on the board of Avance Gas, which is our LPG company, so I share the concerns from John here in terms of the VLGC order book, which is also ballooned. Although there are some good reasons in the LPG business, because we have this technology shift. All the new ships are dual-fuel ships where you can burn, you know, quite similar from LNG. You eat out of the cargo, so you use some of the cargo as fuel. And of course, it's the same driver here in LNG, why you have so many orders. It's EEXI, and it's phasing out the steam ships and replacing those with newer ships. But I think, in general, our biggest concern are people losing their heads and ordering too many ships, which is the customary fare in shipping.
Thank you. John Coustas, first of all, congratulations. Congratulations on your conviction in your company. Congratulations on being a tremendous performing stock within a very strong sector. And give us your view on container market in terms of how you see it playing out.
Yes, thank you, Jim. It's really a pleasure to be back after more than 2 years. I see a bit less people in the streets around, but I hope that's going to change. Well, what I see about the container market, I mean, Ari had, you know, a pretty detailed presentation of what was going on, which is definitely true. I don't think really that the idle numbers, as Ari described, are that high. I mean, practically, I think that at any one time, the average number of container ships that are sitting in ports is around 28%. And now it's reaching something like 33, 34. So it's not really a 10%, kind of shift. Yes, there is definitely delay, but not, I mean, it's all concentrated in what we see and we hear about, U.S. West Coast and specifically in the ports of LA and Long Beach. In the rest of the world, there is minimal kind of waiting time and things are much more smooth. So let's not really exaggerate in that specific item. Now, shipping, like everything, suffers from, of course, a combination of oversupply. My friend Graham did a very good job in all that.
Contributing to it.
Yes, contributing to that. Of course, these are not kind of speculative orders. I mean, in most cases, if, for example, Graham wouldn't order them, liner companies themselves would have done. So it's more driven by liner company outlook. And at present, liner company outlook, of course, it's very cautious because, okay, they've done phenomenal returns for this past year. We've seen ZIM results yesterday, which, for a company that practically a year and a half ago was considered bankrupt. I mean, we had 10% of ZIM shares booked at 0 in our balance sheet. So that, can really tell you, what kind of massive turnaround it's been. And on the other hand, all these liner companies, exactly because of environmental regulations, are reacting relatively with caution. Don't forget that back in 2008, we entered the financial crisis with 60% order book. So there's absolutely no comparison to what is happening today. Plus, today we have also a looming, let's say, environmental crisis, which will force speeds down because reduction of speed is the only, quick fix in the medium term to reach the emissions targets. And the moment that happens, I mean, we already were in touch with all our charterers, I'm pretty sure Graham as well, and we're all exploring various ways on how to slow steam the vessels,
What's the efficient speed to get to the emissions to the lowest?
There's no question of efficient. I mean, the less practically, okay, up to a limit, but the slower the speed, the lower are the costs of the CO2 per ton mile, because that's really what matters in the end. So
and your ships are geared to go over 20 knots, but the
so 25.
and so, but something like 14 or 15 would get the emissions to the basically lowest point possible.
Well, exactly. I mean, today we have, our ships on average operate at something like, let's say the smaller ships are down to 25 to 30% of power. The larger ships, they may go up to 40 or 45, but that's about it. And with the CII requirements, these speeds have to go significantly down, these powers. So, yes, in 2023, depending of course on the demand situation, we may see an actual oversupply, but it all depends on the response that the liner companies are going to have in order to minimize emissions. On the other hand, don't forget that the price of fuel, if it remains as high as it is today, I mean, it will naturally force a slowdown.
Thank you. Øystein, it's easy for you to think like an investor because your boss is a big investor. How do you think about cash returns to investors versus the appropriate level of investments going forward?
I think we've been fairly clear on that, so that's why we're ramping up the dividend. So now we will pay out $40 million quarterly, so $160 million on a yearly basis. Of course, we could use the quarterly cash flow to finance the equity for a new ship. So basically, if we didn't pay dividend, we could order 4 ships and have the equity for those ships in 1 year. We have 13 on the water now, but you know, we prefer to buy ships when they are cheap and when nobody else. So this is like the Warren Buffett, you know, you have to be kind of buying when nobody else is buying and selling. So if anything, you know, we would rather be selling ships rather than buying ships in this market. So, but we're not planning to sell any ships. You know, we kind of put them on backlog now, so we added. We're thinking the same way when we're chartering our ships. So we all ordered the ships because we saw that there was a big technical change on LNG ships, and the ships were cheap. We bought the ships, and of course, John, he founded Golar, so it's not like we are new to LNG, and I also worked with the Cruising company and worked with LNG for 15 years. So we bought them cheap then, and then because you had COVID, you had trade war between China and America, the market was pretty soft in 19 and 20, despite everybody thinking it's going to be red hot markets, because volume growth in 2019 was 35 million tons, it was only 40 ships. So the maths will tell you that 2019 would be a fantastic year, and also 2020, but because of all these reasons, that didn't materialize. Then we chartered the ships on shorter term contracts, either spot or 12 months time charter. And now, when the market has recovered and it's much better than everybody thought 2021 would be a terrible year in LNG shipping because volume growth was muted, everybody thought, and then 54 ships for delivery. But you know, ton mileage took care of that, and also volume growth is quite staggering at 20 million tons this year. So that the market's been good, and then we have chartered the ships on longer term contracts. So we've done 9 contracts now the last half year, where we fixed out the ships for 3 to 5 years, locking in a good return. And then we are distributing that return to the shareholders, and they can go on Black Friday sale next week.
Thank you. And John Coustas, it's easy for you to think like an investor. You're a reasonably large investor in your company. How do you balance the cash back to shareholders versus the appropriate level of investment going forward?
Well, it's easy to return money back to shareholders. Practically, for whatever dividend we pay out, slightly less than half, is going practically to our family. So, I have every intention, really to distribute money. However, we know that shipping is a pretty cyclical industry. We must not forget that. And where you make outsized returns is when you are able really to time also your purchases. It's very nice to have all these long-term deals, 10 years or so. We've done that in the past. We know the whole story. Returns on that are relatively low. To me, I would be very hesitant to do, for example, the deals that my friend Graham has done. It's a different business model, and I appreciate that he doesn't want to be, let's say, considered as shipping, because really, in shipping, it's an industry with outsized returns, but it requires a pretty good management of the cycle. If you really miss cycle and you make all your bets at the top of the market, then the best you can hope is to survive, not to make money. So, for example, to have, let's say, you may have the best possible assets. If you lock them away, at kind of distress rates, because you really want the cash flow, then the moment that you have the spike, you are, you've lost completely really what shipping is there for. I was reading yesterday about, a very fixture of a 4-year-old VLCC, 3 years at $29,000 a day, which was hailed a success. And we have chartered, a 20-year-old, 2,500 TEU ship for $28,000 for 3 years. I mean, just as an example. And that other ship, it's a ship that really you need to buy, you need about 60, 70 million at least today. So let's not forget that a shipping company, really the success of a shipping company is really to manage the cycle and make the timely investments. And now, the time you make the timely investments, if it's not really the time that people will appreciate, and will come to invest. If you go and have an equity raise when the market is in the doldrums, you're going to be hammered. I mean, when, for example, we did our equity raise back in November of 2019 at $6. The stock is now at 73. Of course, for us at that time, we didn't really matter because we were not diluted. We participated pro rata to the offering. But I think it's unfair for let's say, for the investors, just, let's say, to give the money now, and then to force them practically, when the times are bad, and they do not have the opportunity to invest in the company again, to dilute them down. As I said, this can be a relatively short-term strategy. There are investors, of course, there are flippers who just want, to make a quick buck. Of course, this is normal in all these markets. These are the people that provide the liquidity to the stock. However, we have to think not of the flippers, but of the long-term investors who appreciate the management and our business model, and they prefer, of course, to take a dividend. And we are committed also to increase the dividend because at presently the dividend doesn't really reflect today's reality. But in any case, it will not be a kind of a full payout, which will force us later on to dilute shareholders if they want to participate in our growth.
Thank you. John Wobensmith, give us your view on the dry bulk market going forward, and give us your view on dividend policy. I don't expect you to comment on any of your peers, but for instance, Starbucks just reported results this week, and EBITDA was exactly in line, and the analysts missed the dividend number by 13%. So either the analysts don't get it, or the formula's complicated. But how do you think about both the outlook for the market and dividend policy?
Why don't we start with dividends for a second? And John has just done a fantastic case study on how to make money in shipping. So I agree with everything you said. It's all about being good stewards of capital. That's where it starts. And I think the dividend policies of companies, it's a very tricky thing, because when you get into fantastic markets, there is a lot of pressure from shareholders, particularly as a public company, to want you to be paying out higher and higher and higher dividends. A lot of that has to do with the types of shareholders that invest in shipping. I think it's been a while since you've seen long-term, with the exception of private equity, it's been a long time since you've seen long-term investors in shipping. And short-term investors, they want the high dividend, they want the pop, They want to see high leverage. All of these things in our mind are not the way to go. And I'll go back to our dividend model, which again is all about driving our net debt to zero, which will most likely happen by the end of 2023, with a longer term goal of actually getting to zero debt. And what that allows you to do is be in a position to take advantage of the opportunities that John was speaking about earlier, and striking when values are low. Now, you may not always, buy a ship at the lowest point, but if you can buy, as we, in the 25th percentile, low part of values, and you can hang on and be sustainable, eventually you are going to do very well and you're going to have those outsized returns. So the way we've structured our dividend policy is, yes, we are paying out a high number, but we're also continuing to pay down debt. Our debt level at the end of this year is down 60% of the scrap value of our fleet. And what that means is we have no scheduled amort for the next 3 or 4 years. However, we are going to continue to pay and repay the banks, but we're also putting a reserve in place. Again, going back to what John says, you can't pay everything out because you can't do fleet renewal, you can't grow. So by keeping cash back on the balance sheet, continuing to reduce your debt to get to that zero number, having a very large revolver in place, which we do, we have a $300 million revolver in place, it allows you to hopefully get the dividend yield valuation eventually, which I think does take time. And let's face it, dry bulk shipping has really just started paying, sizable dividends again. I think there is a lot of skepticism amongst investors whether that stays in place and for how long. So I think we need to get people comfortable with that again. But also, it's just about reducing the cash flow break even. We'll be down to a little over $7,000 a day. If you back test that to 2,000, and there's maybe 2 or 3 quarters that would have negative operating cash flow where you cannot pay a dividend. That's one of the reasons why you have the reserve, because you can smooth that out a little bit as long as you're continuing to believe in the market. So long answer on the dividend, but just in terms of the market, I'll go back to, because I see we're starting to run out of time here, but it's supply, and dry bulk. We've got a 6 to 7% order book right now. Historically, it's the lowest it's ever been. If you look at the 20 years and older, that's another 6 to 7% that eventually is going to have to go away, and it's probably going to go away sooner rather than later, particularly with IMO 23 coming into play. So I always start with the supply side, and for once in a very long time, the dry bulk shipping industry has good fundamentals on the supply. And even the new buildings that are being done, you're seeing 1, 2, 3 being done for 2024 at a time. Nothing that is, it's more replacement tonnage than it is speculative bets. As I look at China, because there's been so much focus on the demand.
And thank you for going there.
Yeah, so much focus on that. And obviously Evergrande was from a sentiment standpoint quite negative, though I think the Chinese government is going to unwind that in a very slow manner. I don't think it's going to be anything about what the U.S. saw during the financial crisis. And quite frankly, the Chinese government told us what was going to happen. If you go back to their Politburo meeting in December of 2020, they were indicating a more restrictive monetary policy, breaking up monopolies, and that was their focus. And so now they front-end loaded a lot of the steel production in 2021, and now we're seeing much lower utilization numbers. I think it has a lot more to do with power shortages than I do the altruistic cleaning up from a CO2 standpoint. And we do expect in their next meeting in December, they will have a more accommodative policy, which will affect to the positive to the steel industry. I mean, keep in mind, the steel industry is 3 to 4% of China's GDP. They've got to get that up and going again. And I think we will have the normal seasonal first quarter. I do actually think paper is oversold, so I think we're going to do better this first quarter than maybe what the market's indicating, but it is going to be softer than we were a couple months ago. And as soon as the Olympics are over, I think there's going to be a big catch-up game that's played on the steel production side.
Thank you very much. John Hadjipateras, you returned a lot of cash to shareholders in the last year. You did a share buyback program, you did a share buyback tender, and you paid a dividend. Talk about the success or lack of success of those various strategies in the last year.
What has been successful is reflected something in the yeah. It's reflected in the share price to an extent. I mean, I'd like to think it would be better rewarded, but it reflects basically what we've done. It reflects our approach to the business as a whole. I mean, we take a balanced approach to everything: investment decision, charter cover, debt level, and return of capital. So we've looked at it from that point of view. I think that to capture the outside returns that John was talking about, and which you need in shipping in general because of its volatility, you need those outside returns from time to time in order to bring your generally lower than adequate return up to adequate or good. So we keep a balanced chartering policy. We don't think, I'd love to think of no debt, but I don't think it works completely, especially in a public company. I also know for sure that high leverage is unacceptable, even though from time to time some investors would prefer to see that. But this is our approach in general, and this is how we're making our decisions currently too. I mean, we've been disciplined in the tonnage renewal. We've ordered one ship only. We've committed to take 3 long-term charters from other ships which were already contracted. They have dual fuel capability. They're different in the sense to the general fleet of VLGCs because they're compatible. They go through the old Panama Canal, so we get around some of those issues, and we expect to continue the return of we haven't made a commitment yet whether we're going to be doing more buybacks or dividends. So a dividend was described as a special dividend and or extraordinary, but not unrepeatable.
No, it was very successful. Your share price went down almost not at all.
So I expect that we should be continuing with that.
Thank you. Graham, we have about a minute. Can you give us an outlook on your strategy in 60 seconds?
Yeah. Firstly, just to clarify for everyone that doesn't know us, these 70 new builds are all backed by customer contracts, so it's driven by customer demand, so we don't speculate on these vessels. And, you know, as John said, different business model. We look at long-term contracted cash flow up to 18 years. Could I put things out on 3-year contract? Of course I could. But then I'm going to have to renew them when the market's going to be soft with all the new builds coming on. So it's not a risk that I want to put my shareholders in front of. So there's a lot of things still driving the market. I think there's a lot of consolidation to happen around some of the smaller vessel classes. There's a lot of the people have talked about technology is going to be driving, I think, a lot of the shifts in the next couple of years as we look to different propulsion. 25 of our new builds are dual fuel, LNG, but LNG is not the end game. It's a step on that journey, and I'm not clear where that journey is going to end. We're involved with many of our customers on methanol, ammonia, and others, and that's just going to play out over time. So it's about how do you make sure that your portfolio is safeguarded against all of those things. I think the demand, there's just been a hiatus. There's been lack of ordering for a number of years. I think people have been sort of not sure where the propulsion and the CO2 emission policy is going, so they've been very reluctant to commit capital. And a lot of what we're seeing now is sort of we've waited long enough, now it's time to get back and start renewing the fleets and moving forward.
Thank you very much, and thank you. Yes, sir.
Jim, I just have one 30-second Since we have a lot of bankers, I think, a public listed shipping company should not have zero debt. When I went to business school, we learned that equity is a pillow, debt is a dagger. If you want lazy management, that's a simple way is to have no debt. And then you have this seminal paper by Michael Jensen and Meckling from 1976, which is the agency problem of a public listed company. And of course, they have the optimal balance, because if you have debt, the management has to deliver results, otherwise they go bankrupt. So you need to have the optimal level of debt is the level where the cost of financial distress equates with the cost of the agency problem. So I think we should have a lot of debt, and we're actually doing the opposite. We're adding debt because debt is so cheap now. So we just announced a refinancing, Asian lease, $160 million, taking out the bank loan, $123 million, and the cost is less than 4%, 10 years tenor, no financial covenants. So then you don't really have a lot of financial distress.
Thank you very much.
Of course, but we have to, one last thing. Certainly the management team at Genco is not lazy. I don't know if you've followed it for the last 5 years, but there's been a lot going on there. Look, the zero debt is, again, to get that sustainable dividend and be priced off a dividend yield instead of this crazy net asset value that moves around all the time. And by doing that, we actually think we can start trading at a premium and actually using our equity to buy shares. And this really hasn't been tried in dry bulk, so we are going to move forward. And I can't say enough about the lazy management team. That was fantastic. Thank you for that.
Well, Michael, thank you for giving me 5 extra minutes. Sorry we took 10 extra minutes. And thank everyone on the panel very much for your comments.
Thank you.